2 ways to move your property from your personal name to a limited company without paying tax. Look, most landlords are paying thousands in unnecessary tax simply because they transfer their property the wrong way. But if there was a legal way to move your portfolio into a limited company without getting hit with stamp duty and capital gain tax, would you do it? Listen, if you can invest 10 minutes to learn the 2 ways to move your property from your personal name to a limited company without paying tax, you might as well give your investment properties away because it's not good to do that. But here are the 2 easiest ways to move your properties from your personal name to a limited company without paying tax. Right now, many UK property investors are trying to move properties from their personal name into a limited company, usually because of tax efficiency, mortgage interest changes, long-term scaling. But here's the problem: HMRC doesn't see it as a simple transfer. They see it as a sale, which means stamp duty, legal fees, and capital gain tax. Suddenly, one move can cost you tens of thousands of pounds. By the time you finish watching this video, you know exactly what to do to avoid paying tax. Look, I've spoken to many investors who's rushed this process without understanding the structure properly. They thought they were being smart, but ended up triggering massive tax bill they didn't even expect. And honestly, I understand why. Property taxes in the UK can feel like walking through a minefield blindfolded. One wrong step and a boom, expensive mistake. When I started building my property portfolio, I realized very quickly that property investing isn't just about buying deals, it is about structure. Because the differences between amateur investor and smart investors often comes down to one thing: understanding the roles before making the move. Here are the 2 key reliefs you can take advantage of to either delay or eliminate your tax. The first relief is called Section 162 Incorporation Relief. This can help you defer your capital gain tax. In simple terms, instead of paying the tax immediately, it gets rolled into the company shares for later. Think of it like pressing pause instead of stop. Now, this doesn't magically erase tax forever, but it can significantly reduce the upfront hit. Here is where professionals mess up. They assume owning one rental property automatically qualify. It doesn't. HMRC needs to see this as a genuine business activity. In essence, you got to be in it to win it. Oh, sorry for interrupting this video. I just wanted to draw your attention to a guide I've just created. This guide is for you if you're looking to start and scale in property investment and you've got questions that you want to ask in order to start your property investment. This guide is the ultimate guide to start and scale in property investment journey. I talk about the different type of investment strategies. I also discuss the 11 ways you can raise finance to make any property no money down deals and the type of properties to buy in order to generate a serious return in your investment. And I'm giving this book away for completely free of charge, no string attached, nothing, absolutely free. Click the link on the description of this video to get your free guide now. We've only got a limited number of these copies available as well, so click the link to get your guide now. Let's get back to our video. Relief number 2. This is my favorite. Partnership relief. Now, this is the one that can help reduce or remove stamp duty completely. It is called the partnership relief. Here is how it works. You place the properties into a partnership structure, usually an LLP, which stands for Limited Liability Partnership. But there's a rule. You generally need 4 or more properties. You need to prove that you're actively involved in the business, usually working 20 hours plus per week. That could include admin work, maintenance, tenant management, managing refurbishment. Then typically after around 2 years inside the LLP structure, the portfolio can be incorporated into a limited company. Here you got to be patient, consistent, and obviously involved in doing the work. But trust me, it's worth it. Here is the thing. Most investors treat tax like an afterthought. Smart investors treat it like the foundation of the building, because a weak structure eventually cracks, no matter how good the property looks on the outside. Now, let me be clear. This is not something you do by yourself. From a TikTok video, one misunderstanding could cost you more than the property cash flow itself. That's why you need a good solicitor, a good accountant, proper documentation. The investors who save the most money aren't always the one making the most. They are the ones structuring things correctly. And honestly, this is the part nobody talks about online. Everyone talks about buying properties. Very few talk about keeping more of the money you make in your investment properties. Because making money is one skill, protecting it is another. So if you're thinking about moving property into limited company, don't rush it. Understand the structure first. Understand the tax implication first. Because one smart move could potentially save you thousands. Property investing isn't just about buying assets. It is about building them intelligently. If this video helps simplify things, comment below and let me know your biggest takeaway. And if you want more UK property investment strategies explained in simple, basic English, hit subscribe so you don't miss the next video. Because the goal isn't just to build wealth, it's to keep more of it.